Hello everybody, my name is Mark. Welcome to another one of my investing videos. It's been a while, but here I am back again doing more videos about stock options and trading options, option trading. And in this video I am going to show you, or rather explain, how to protect your covered calls when you sell covered calls. And it may sound like an oxymoron to say protect covered calls, but believe it or not, there are times when you may buy a stock, sell open some covered calls, and the stock may actually go the way that you want it to go, and the underlying value of the stock goes higher than the strike price of the call option that you sell to open, which is what you want. Believe me, you want the stock to go higher than the strike price of the call option. That's a good problem to have because it means you're going to make maximum profit on your covered call trade. But let's say that you don't want to sell your shares, you want to stay in the game and you want to make more money on your current trade that you're doing. Well, that's what this video is about, and I'm going to show you how to do that. Now, first of all, let me show you what I did with my money here. And just recently, I think about a couple weeks ago, I bought another 200 shares, and here it is right there, of US Steel. That would have been on June the 4th. And today is June the 23rd, so that would be about 2.5 weeks ago. I bought another 200 shares of steel at $13.14, and the reason why is this. I've got my trading view here, and let me go to the 1 month chart here. This is the 1 month chart, and you can see that steel kind of hit a bottom here at around the $11 level. And when I realized that it hit a bottom, I felt, okay, it's time to do some dollar cost averaging and buy some more shares of steel. And so I bought it right at around here, 1308, and I sold to open actually it would have been down here, and right there is where I sold the covered call at 1350. And when I saw that steel was going to keep going up higher than my strike price, and steel is a very unpredictable stock. It's very hard to know what it's going to do, but one thing I've learned about this particular stock is that steel makes big moves, okay? If we look at the chart on steel, this would have been on like May the 31st, June the 1st or whatever, and it was down at 1178. And now here it is a month later. Now it's up to 1466. So that's like 20% in a month. And if we go back 6 months, steel makes big moves. Okay, this is not a little moving stock. It makes big moves, and that's good. If you're an option trader, this is what you want. You want stocks that make moves like this. You don't want to buy stocks that, today it's worth $20 a share. A month from now, it's worth $20 a share. 6 months from now, it's worth $20 a share. Those aren't the kind of stocks that you make money on. These are the kind of stocks that you make money on. The stocks that, a few months ago, it's at $24 a share, and now it's all the way down to $11 a share, and now it's up to like 1466. Is it going to go back up here? Who the heck knows? But I thought, okay, it's time to increase my position, and now I own 400 shares of steel. And real quickly, this is my position right here. And there it is. I own 400 shares of steel. I have owned 200 shares of steel for the longest time, and I bought protective puts. Started out as an option caller, and it just kept dropping, and I've made over $900 profit on the puts. My dollar cost average, when I initially bought the 200 shares of steel, my dollar cost average was $20.66. If we go back to my original transaction here, I think it was all the way back in March. Let me look at March here, and let me see if I can find where I bought that, and let me put an X, because I was doing a lot of nonsense with Microsoft when I lost some money on that spread. So here it is, March the 12th, and you can see I bought, my dollar cost average is $20.66 a share. You see 2 orders there because of a mouse click error that I did. I accidentally canceled the order and 35 shares got filled, but whatever. I got 200 shares of steel at $20.66 a share, and you might think that'd be a bad thing, but luckily for me, I've been buying puts. Okay, I bought two $20 puts for $399 a contract, got two of them, spent $806, and I've been constantly selling to close those for profit. Here you can see I spent $806, sold them for $1,151, so I made a nice almost $300 profit on that. And then I bought three $15 puts, spent $864 there, and then down here I sold to close them, made $1,200 for that. That's almost a $400 profit. Then I bought four $13 puts, and I spent $1,195. And then here I sold them for $355, made $1,409. If you were to add up all the greens and all the reds, I've made over $900 in profit. I recently did buy another 6 puts at the $10 level. And I put in $1,200, which banks another $200 profit. And so my dollar cost average, which was $20.66, if you do the math, is down to $15.75. But when I saw that steel started going up, that's when I decided to get the 200 shares right here. That's what I did. But then I sold to open 2 covered calls right there, $13.50. Brought in, let's see, where is it at? Where are the covered call? Here it is right here, $13.50. So I brought in $103. So I took in $204 a contract there. So wait, is that right? Where are my original 13.50s? Here it is right here. Okay, there. My memory was failing me. So I bought the 200 shares, and I did that all on the same day. See, and that's what got me tripped, okay? It actually put the 200 shares, it actually reversed the order, but it all happened at the same time. You can see 14.16, 14.16, June 4, June 4. I bought 200 shares and sold to open 2 covered calls at $13.50, took in $64.47, and then steel's been going up, and I could have just very easily and simply just allowed my shares to get taken away. My dollar cost average of those 200 shares is $13.14. Steel went over $13.50, so I could have made the $36 a share times 2, which would have been, I would have made about, actually, let's calculate this out. Let's see, 36, so 70 something dollars plus this, 76 plus 64 is 130. So I would have made about $130 if I would have let it get called away. But I wanted to stay in the game, and so I bought the close at 146, and I sold 2 more covered calls, 103, and took in 204. So that's a credit. And steel, as of right now, is still up nice and high at $14.67. Now, here's the other thing that I did, and this is the crux of this video. This is what I want to show you what I did. So when I sold to open, or when I bought to close those and I sold to open those, okay, I did the same thing in another account in my Schwab. And in my Schwab account I have some money, and I bought another 100 shares here, and I have no covered calls sold on those. I just own the shares straight up, no selling calls, no puts, nothing. Okay, and let me go to my transaction just so I can get the date right, and then I'll explain how does this protect my covered calls. So let's take a look at where I bought those 100 shares. Let's see, that would be, where is it at here? I believe this would be it right here. Yeah, this is it right here. Buy 100, and my dollar cost average is $13.83. So that's what I bought it at. Okay, now why did I do that? Okay, the reason why I did that, and this is really good if you have a Roth IRA. Okay, if you have a Roth IRA or a 401k, you have an account that you don't want to take extra risk, and so you do things like you sell covered calls. You see, this is my Roth IRA. This is where a lot of my money is, my retirement. This is the money I hope I live on someday for the rest of my life. When you have a Roth IRA, okay, and you're trading options, right, because you want to make some money and you want to try to make some return, whether you're buying stock and you want to protect yourself or you want to make some income. In my case, I want to make some income. I want to protect myself, you know, all the above, okay. And as you saw, I bought 200 shares of steel, right? And I sold to open these $13.50 calls, but steel was going up. Well, I want to have a nice big payday, but simultaneously, I don't want to take any more risk in my Roth IRA. So that's why I turned to my other account, my Schwab. Because by going to my Schwab, okay, actually, let me go back to my Ameritrade. Okay, if I would have bought the 100 shares in the Ameritrade, like let's say that I sold to open these 13.50 call right now, and then you see steel up to 14.68. Now, if let's say that I only had the 200 shares, I didn't have the 400 shares. If I'm going to buy another 200 shares right now at 14.68, okay, then that's another like $2,800 and some change that I'm risking to try to make extra money to protect my 13.50 covered call. Now, the reason why it protects me is because if I don't buy extra shares and steel just keeps going up and away, right? If it goes back to its original levels in the $20 range, at the $20 levels, then I'm going to miss out on a big payday. Because when you sell covered calls, you're selling the open call options on a stock that you own, like I'm doing on steel, right? And when you sell open call options, you're the option seller. You're giving somebody else the right to buy the stock from you, okay? And so obviously, if I sell the open 13.50 call option, I'm giving somebody else the right to buy 100 shares or 200 shares of steel, $13.50. Now, if steel goes all the way up to 15, 16, or let's say it goes way up to $20 a share, of course, that person who owns that call option is going to exercise his right. He's going to buy those 200 shares of steel from me at $13.50, and now he has 200 shares of a stock that's worth $20 a share. So obviously that's what he's going to be wanting to do, and I'm going to be sitting here scratching my head asking myself, why did I just give somebody else the right to buy steel at $13.50? That's the reason why that when you sell covered calls and you see the stock price go up, nothing wrong with that. It means I am going to make money, right? My dollar cost average was 13.16. What was my dollar cost? Actually, I'm having a brain fart here. My dollar cost average was 13.14. So if steel goes to 13.50, then I'm making profit, right? Plus I'm making all this, right? Nothing in the world wrong with that. But steel goes all the way to 20. Wouldn't I want to make $7 or I'm sorry, $6.50? Wouldn't I want to make all that extra money? That's the reason why when you sell covered calls and you see the stock go up and it blows past the $13.50 strike price, then the first thing you want to be thinking is, how do I make the profit? So you buy more shares, right? But here's the catch, okay? If I were to buy the more shares in my Roth, now steel right now is at $14.68 a share or whatever, right? Now, if I were to buy more shares right now, what if steel turns around and goes back down to $13.50 or $13? If it does that, right, $14.67, that's $117, right? That's $1.17. So if I own, let's say, 200 shares, that's another, $234 that I could lose, right? If steel goes back down. If I were to buy another 200 shares or whatever, 100 shares, then that's an extra risk. And because this is my retirement account, in other words, I don't want to lose money in my retirement, that's where the multiple trading account comes in. See, now that I own the extra 100 shares in my Schwab, which is a regular individual account, right? Individual account. Now as steel goes down, I still don't want steel to go down, but if it does, at least my losses will not come from my Roth. My losses will come from my individual account, and I'm okay with that, And then my plan, as I wrap up this video, I have a very simple plan, okay? My current plan right now is to keep an eye on steel, and if I ever see steel hit $13.50 between now and whenever, then I am going to close out my 2 covered call contracts right now. These will drop in value, and I'll make whatever profit that I'll make on those, right? And let's see, when I sold those last covered calls, what did I get? I got $103. So if steel goes to $13.50, I'm going to make a profit on that. And so I'll close those out. I'll make a profit. And then I'll sell my 200 shares, which those dollar cost average was $13.14. So I'll make that profit, right? And so I'll probably make around $200 profit, and that will be tax-free profit in my Roth IRA. And then my shares of Schwab, which is an individual account, I'll be in the red, because my dollar cost average was, if my memory, I always have to go back to my transactions because I have brain fart. Okay, my dollar cost average was $13.83, so I'll be in the red by, I bought 100 shares, I'll be in the red by $33. Guess what I'm going to do? I will be out of those. I will be out of those 200 shares in my Ameritrade, in my Roth, and instead of owning 400 shares, I'll be back down to 200 shares. I'll make a clean profit in my Roth IRA, and then guess what I'm going to do in my Schwab? That's right, I'm going to start hedging the crap out of it, and I will buy put options. Maybe I'll do a ratio spread or something, and if I see steel turn around, start going up again, I can always get back in my Roth. So it's a very safe thing to do, and it's a very good thing to do. So moral of the story, if you could follow me through all of this rambling I've been doing, that when you sell covered calls, right, it can be a good thing to do in an account that you don't want to take a lot of risk, right? But when you sell those covered calls, there might be a time when the stock blows past the strike price of the call option, and there's nothing in the world wrong with that, because if it does that, you will make money. But if you want to make a big payday money, then consider opening up a multiple account, a separate account, an individual account, like I did with Schwab, and then you can buy another 100 shares or 200 shares, and now if steel goes up, if it wants to go up to $20, then I'll make very good money here. I have no plan whatsoever to sell my 100 shares in my individual because I don't want to pay taxes, and I will just very simply continue to sell to open these calls, or maybe I'll just buy another 200 shares or whatever. But I can do whatever I want. I can make money very safely, and I own 400 shares. I'm only selling to open 2 covered calls, so I still own the extra 200 shares, so I will still make some money. But by buying an extra 100 shares or 200 shares, in my case I bought 100 shares, by buying extra shares in a separate account, that's a good way that you can protect your covered calls in an account that you don't want to increase your risk, like if you have a Roth or a retirement. So that's it for this video. I hope you got something out of it. As always, if you have any questions, comments, feedbacks, or whatever you want to leave, feel free to leave that in the comment box. Likes, subscriptions, whatever you want to do. Thank you for watching my video. I appreciate any support, and I wish everybody have a good day, happy trading, and I will see you in the next video.